Hi everyone, I am Hannah Jane Abraham. So for the introduction, what is a financial instrument? So financial instruments are those contracts that give rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Financial instruments are assets that can be traded, or they can also be seen as packages of capital that may be traded. So most type of financial instruments provides efficient flow and transfer of capital all throughout the world's investors. So these assets can be cash, a contractual right to deliver or receive cash, or another type of financial instrument. So here are some examples of financial instruments. So first is the investment in equity instruments of another entity. The next is the derivative. So this is a contract that derives its value from the performance of an underlying entity. Then the third one is the debt instrument. So these are assets that require a fixed payment to the holder, usually with interest. The next is the compound instruments such as a convertible bond. And lastly is a deferred purchase. Next one is the valuation of financial instruments. So this is commonly required for financial reporting purpose in case of business combinations, shared payments, and tax allocations, and etc. So the fair value of a financial asset or liability on a given date is the amount for which it could be exchanged or settled, respectively, on that date between two knowledgeable, willing parties in an arm's length transaction under market conditions. That's all.
Good day, everyone. I am Margaret Blanche Brizo. So let's talk all about the income approach for valuation of financial instruments. The income approach values a business based on its future benefit stream, measured by free cash flow. Valuators use one of two methods, the discounted cash flow or the capitalization of earnings method. The primary differences between these two methods is that a discounted cash flow utilizes projected cash flow, whereas the capitalization of earnings method uses current cash flow. So the cash flow is then discounted, which is using a discount or risk rate, or capitalized, which is divided by the discount rate less the long-term growth rate. So the income approach is the valuation approach that converts maintainable or future amount, which is the cash flow or income and expenses, to a single current, which is the discounted amount. So um, this approach value of financial instrument is determined based on the expected economic benefits by the way of income, cash flow, or cost savings generated by such financial instrument and level of risk associated with such financial instrument. It generally involves discounting future amounts to a single present value after adjusting inherent risks. Black-Scholes-Merton formula or binomial model and similar other pricing models are examples of income approach that incorporate present value techniques and reflect both the time value and the intrinsic value of an option. When reliable market data is hard to find, the business valuation expert may turn to the income approach. This approach converts financial expected economic benefits to cash flow into present value because this approach bases value on a business's ability to generate future economic benefits. It's generally best suited for established and profitable businesses. The capitalization of earnings method capitalize established future economic benefits using an appropriate rate of return. The expert considers adjustments for such item as discretionary expenses, for example, for above or below market owners expansions. So non-recurring revenue and expenses, unusual tax issues, or accounting methods and differences in capital structure. So this method is most appropriate for businesses with stable earnings or cash flow. So this the discounted Cash flow method also falls under the income approach. In addition to the factors considered in the capitalization of earnings method, the expert accounts for projected cash flow over discrete periods. So let's say 3 or 5 years, and a terminal value at the end of the discrete period. All future cash flows, which is including the terminal value, are then discounted to present value using a discount rate instead of a capitalization rate. As the market approach, the income approach can generate a control or minority level value depending on whether discretionary adjustments are made to the future economic benefits. Next is the pros and cons of the income approach. The income approach is one of the most often used valuation methods. So there are numerous reasons why evaluators prefer these methods over others. So the pros. First one is consider the flexibility in using the income approach, particularly with the discounted cash flow as many moving parts. So including the components of free cash flow, the discount rate, and the terminal value. So this allows the evaluators to use their best judgment and the facts of the case to pinpoint their estimation of the value of company being valued. Second is the income approach uses free cash flow as a base for both methods. So free cash flow is generally seen as the most accurate way to measure cash flow available to shareholders after deductions for taxes, capital expenses, working capital, and etc. So in cons, there are two cons for the income approach. First one is the projections used in a discounted cash flow must be backed up by historical performance and sound reasoning and or explanation. So for the management team as to why the projected cash flows are feasible. So value can easily be overinflated when using a discounted cash flow as the inputs are very sensitive. Second is no one has a crystal ball. So a discounted cash flow is done using projections of how a company may perform based on the information today. So the evaluator must be aware of the reality and choose an appropriate discount rate accordingly. This approach allows value to be forecasted based on different scenarios and can be used to form a sensitivity analysis.
So there are steps in applying for the income approach valuation. These are: number one, estimation of annual cash flows a prudent investor would expect to receive from the subject property over a defined period of time. Number two, conversion of estimated cash flows to their current value equivalent using a rate of return that accounts for relative risk of the projected cash flow and the time value of money. Number three, estimate of residual value, if any, at the end of the defined operation period. Number four, conversion of residual value, if any, to its present value equivalent. Number five, addition to the current value of estimated cash flows from the defined projection period to the residual value, if any, to arrive at the company's enterprise value. And lastly, deductions for working capital, intangible property, and other excluded assets of the enterprise value to arrive at the indication of value for the subject company's tangible assets. So, as I previously noted, the income approach can be combined with the cost approach which will allow the direct valuation of tangible assets and indirect valuation of intangible assets. Intangible assets can also be modeled separately, and that value can be checked from the resulting residual intangible value from the business enterprise income approach. This combined approach will provide a defensible fair value for most purposes where a business valuation is needed, in addition to providing values for different types of assets. Regardless of the purpose for seeking a valuation, arriving at accurate, defensible values for business assets is arduous and complicated process requiring the skills of experienced valuation professionals. A business valuation expert has the knowledge and experience needed to choose the best valuation method for your specific needs and calculate a fair and accurate value.
Good afternoon, everyone. Good afternoon, Miss. Our topic is about the cost approach valuation of financial instrument. So, what is cost approach? So, the cost approach is a real estate valuation method that estimates the price a buyer should pay for a piece of property is equal the cost to avoid to build an equivalent building in the cost approach. The property's value is equal to the cost of land plus total cost of construction less depreciation. So it yields the most accurate market value for when a property is new than through alternative methods. This concept assumes that the cost of a property should be more or less equal to the cost of constructing an identical building. So, the cost approach method values real estate by calculating how much the building would cost today if it were destroyed and needed to be replaced from start to finish. It also factors in how much the land is worth and makes deduction for any loss in value, otherwise known as its depreciation. So the logic behind the cost approach is that it makes little sense for buyers to pay more for a property than what it would cost to build from scratch. Then considers today's cost to rebuild and adds the value of the land. Second, based on the anticipated cost to recreate, replace, or replicate the assets. Then sets the upper limit of value, and this approach is most appropriate for the appraisal of new property, not old. And thank you. That's all, Miss.
Good day. I'm Nicole May Tizon, and I'm gonna discuss about the pros and cons of cost approach. So the pros of cost approach. The first one is it is accurate in evaluating special use and unique buildings. Then the second one is it does not focus on the prices of similar homes. Rather, it calculates how much the building would be if it were created from scratch. And the third one is this method factors in the worth of the land and already makes deduction for any loss in value. And the next one is the cons of cost approach. There are two cons of pros of approach. The first one is comparable land may not always be available, which means that the appraisal may not always be accurate. And the second one is in practice, this method is considered less reliable than the income and comparison. The next one I'm gonna talk all about is what are the limitation of cost approach. So the first limitation is no vacant land. This this approach implies that a buyer will be able to locate a vacant plot of land on which to build a comparable structure. The information regarding the property will be wrong if there is no vacant land. Next is unrestrictive authorities. It may happen that an area is already full developed and there are strict rules on new developments. It would be impractical to estimate land values in situation in situations such as those. And the last one is cost approach may be unreliable. In older properties depreciation, the cost approach may be unreliable. Materials used in an old building may not be available anymore. Therefore, the estimated data might be subjective.
So when do you use cost approach? There are five ways when to use the cost approach. The first one is special use properties. The second one is new construction. The third one is insurance. The fourth one is commercial property. And the last one is special considerations. First, let's talk about special use properties. Special use properties is the cost approach which is required and sometimes it's the only way to determine the value of exclusive use buildings, such as religious buildings, hospitals, libraries, and other non-income producing buildings. Since most of these buildings neither yield an income, and if they do, it's often at non-market rates, nor frequently transact in some markets. The cost approach can be either the primary or the sole approach for valuation. Although calculating appropriate depreciation can be challenging in these instances, most cost manuals include reference charts to help appraisers determine the right amount of depreciation. The second one is new construction. It is the cost approach which is often used for new construction. The ideal stage to utilize the cost approach is when constructing or proposing a new property. Given that construction expenses associated with erecting a new building should be readily available to the appraiser. These costs are often the best indicator to determine a property's value. While some buildings may be improved beyond market standards, but generally, the most compelling reflection of the cost approach is when the actual price to construct a property is known. The over-improvement issue would likely be adjusted for an associated sale comparison approach, which would be then reconciled with the cost approach to reach an appraiser's value conclusion. The third one is insurance. Insurance appraisals tend to use the cost approach when underwriting homeowners' policies or considering claims because only the value of improvements is insurable and land value is separated from the total value of the property. The choice between depreciated value and full replacement or production value is the determining factor for valuation. Often, when an appraisal is ordered for insurance purposes, a cost-based valuation is required. For example, when an insurance company needs to know the exact amount to insure a building, which requires separating underlying land value from the building's worth, in this case, the cost method would be the most relevant approach to valuation. The fourth one is commercial property. The cost approach is occasionally relied on to value commercial property, such as office buildings, retail stores, and hotels. The income approach is the main method used here, although a cost approach may be implemented when design, construction, functional utility, or grade of materials require individual adjustments. The last one is special considerations. Most residential appraisals do not use the cost approach. Instead, sales comparisons usually drive market valuation of these types of properties. When a cost approach appraisals come in below market pricing, it can be a sign of an overheated market. Conversely, Regular evaluations above market pricing may signal a buying opportunity. An exception is the property is under-improved or over-improved for its neighborhood. In this case, an accurate estimation of the value of improvements adds to the precision of the determination of value, which is not possible using only the comparable approach.